Welcome from New York, where we have a state of emergency because it's snowing. That's tended to dominate conversation rather than the big event of the weekend, which was the shock, remarkable victory for the far-left Syriza party in the Greek elections. That has had almost no impact on markets outside Greece itself. If we take a look at the FTSE Euro First 300 index of European stocks as a whole, you can see it's on really quite an impressive rally at the moment when measured in terms of euros. And even though that's in large part because of the weakness of the euro, even in dollar terms, you can see we're far, far stronger than at previous difficult episodes of the Eurozone crisis. If you were to take a look at bond yields, Italian and Portuguese bond yields are actually down for the day. No fear of contagion there. If you look at the euro, after its recent weakness, it's actually up for the day. Plainly, there is a belief that the risks of this situation, of this result, have been amply priced in. Now, some of this may be down to complacency. Traders, at least on the east coast of the US, are distracted by the weather. In most parts, I think it's probably down to the announcement last week of sovereign QE from the European Central Bank. That floods out the news from Greece in many traders' minds. After all, if you're worried about contagion, what you would do is sell European government bonds, and a very large central bank has just promised to buy European government bonds. Finally, there is a sense that compared to 2.5 years ago, there's not all that much that Syriza can do, that ultimately it won't be able to get a haircut on its bonds, but it will at least get some kind of an extension in its maturity, and that will be an end of the issue. Now, that may well be right. I think the notion that ultimately the Eurozone will muddle through is probably the single most likely scenario, but it does concern me that the market isn't pricing in more risk as a result of this remarkable event. This will have political repercussions elsewhere, particularly in Spain, which has its own election later in the year, and this crisis has always been primarily political rather than fiscal. Plainly, also, uncertainty does rise. The risk that Greece does default, or that it does leave the euro, is higher now than it was last week. Even at low levels, that ought to justify some degree of concern in markets. Finally, we need, as ever, to think of the effect on China. If you take a look at this chart, you can see that after the euro's weakness, the yuan is as strong against the euro as it has been in over a decade. This is an issue potentially for the Chinese. It might lead to the point where you need to see some kind of response, some kind of deliberate weakening of the Chinese currency against the euro. That would be a very significant event, one that does create some concern. As it is, for the time being, the market seems to have taken this news in its stride. For the rest of the week, we have significant risk of strange events on low volume, given that it's likely that a lot of traders aren't going to get to their desks in New York for the next day or two. And that's particularly intriguing given that we actually have a Fed meeting on Wednesday, which in the current environment will, as ever, be very important. But for now, the market seems comfortable. There's nothing to worry about in Greece. And here in New York, at any rate, they're more worried about the snow.